Hello, friends of Alabama TV. My name is Raul Trujillo, and today we're going to have a very interesting conversation about taxes. And that's why we have here one of my best friends and also my partner, Edward Scott Jr., who is a CPA right here in Alabama. Hey, Scott, how are you?
Good to see you this morning. Good to be with you.
Yes, tell me a little bit about you.
Okay, I'm self-employed, and I work as a partner with you and your business, and I've been working with taxes since 1968. I did my first tax return, and I worked with IRS for about 40 years as an IRS agent, and large case coordinated large case with IRS local here in Birmingham, and so I've been doing this for many years, and I enjoy dealing with taxes.
Thank
I'm
you.
a local CPA in this area also.
Thank you, Scott. Okay, let's talk about what is coming for the new tax season for 2025. Tell me just a little the most change we have by this change the Mr. Trump signed in
Okay.
the big beautiful bill.
Okay. Well, in that big beautiful bill, we have many changes. First of all, you got to change to the tax rate. The tax rate for beginning after 25, it goes from 10% to 39.6%. At the present time, your tax rate goes from 10% to 37%. Well, that's major change for the tax bracket. And within those numbers, you got a certain income level that the different rate will hit you at. So that's why if you have any issues or you need your tax done, you need to come so we can make sure that you're getting treated properly and you're being able to get the correct deduction. Also, they have changes on your interest. They got an interest that's new this first time, beginning 25. Now you'll be able to deduct your interest on your car. That'll be up to $10,000. So that's going to help a lot of people, especially with those that have cars. So then you have other changes. You have changes to your standard deduction. You got standard deduction changes. So we're going to hit some of those also. And you got changes and to your child tax credit, your child credit, and you got changes to your child credit and your dependent credit. So those are just some of the changes. And also one of the major ones is SALT. That's the state and local income taxes. That has been changed substantially. The cap used to be 10,000. That is if you had state taxes or tax on your house, locus taxes, you could only deduct 10,000. So that change went from 10,000 to 40,000. So that is one of your biggest change now, and that's going to help a lot of people, particularly in the West and up in the Northwest, where the real estate taxes are very high. So those are just some of the changes, and they have others, and we'll cover those later.
Yeah, sure. Actually, one of the most questions we receive right here is about the earned income credit.
Yeah.
Who qualifies for this credit?
Okay, you have a child within a certain age. Normally, your child tax, your earned income credit. If you have a person that up until age 1, up to he's what I think it's a student. If you're a student in college, they go up to age 22, and then if a person is able, then there's no age limit. So you got a qualifying child, someone that you're taking care of. They're in your house or they're away at college, then you would qualify for the earned income credit. There are also income levels. You got income levels, 100,000 if you're single, and then I think 200,000 if you're married, filing joint. You got an income limit where the deduction phases out. But for the qualifying child, anyone that you're taking care of, they got a Social Security number, ID number, would qualify for the earned income credit.
This is another question. Just to qualify for earned income credit, you must have Social Security number, correct?
Yep, that's correct. They changed the law this year, beginning 25. The parents have to have a Social Security number along with the child that you're claiming now, in order to get that credit. That is correct.
All right.
This year.
Yeah. Okay. What about the credit for the students?
Okay, the credit for the student, for your qualifying credit for your student, you got to have a valid Social Security number. Okay, you got to be child has to be maintained by the parents. That they're providing support for them, and they are taking care of them. So your student, as long as you're qualifying as a qualifying child in your home, you're being provided care, your parent taking care of you, or if you're in college, you still can qualify for that credit as a student. There are some age limits, and the age limits basically they'll carry you through college now, but at about 22. Then if you're disabled, then there's no age limit.
For that credit, the student must have as well social security number,
That's
right?
correct. Most of these credit, on all these credit, pretty much the student or the qualified dependent got to have a social security number.
All right.
That's one of the major requirements.
Correct. Well, there is another question right here. It is very interesting. So, if you put the standard deductions versus the itemized deductions, what would be the difference?
Okay, the difference is with the standard deduction, that's the amount you're allowed by statute. What I mean by statute, by law. The law states that beginning 25, if you are filing jointly, you can get up to about 21,000, 31,000 some. And if you but that's if you're head of household, about 22 is about 20 head of household about 22,000. You file other filing bracket is about 18,000, beginning in 25. The difference being is that your itemized deduction, you got certain categories on your tax return on the form Schedule A, 1040 Schedule A. It says itemized deduction. On the itemized deduction, if your total itemized deduction exceeds the standard deduction, the amount that you're allowed by law, then you would pick up and go ahead with your itemized deduction. And some tax program, they're automatically set up where they would give you the higher amount. So your itemized deduction will consist of your medical and dental. It will consist of your taxes. Now, that medical and dental also include your insurance premium, like Blue Cross Blue Shield, whatever you pay, whatever company you pay, you can deduct that up to, I think, a 10% this year. It used to be 7.5%. But I think this year's 10% beginning 25. You can deduct your medical and dental expenses. You can deduct on the other category, going to be your taxes. It's going to be your state and local taxes. You can also deduct the tax on your car tag, the notice you get out that you come to your real estate tax, the state and local taxes that take out on your W-2, and you can do your car tax, and that'll be that's your taxes. The next category going to be the mortgage interest on your home. No change in that. The changes are still the same. The maximum up to 750,000, your limit on your home. So there's no change. The next category you can deduct would be your contribution. That would consist of your church, Good Salvation Army, Goodwill. You can deduct your contribution up to, and that's going to be, I think, 60% of your just gross income is the maximum you can deduct for your contribution. So if you add all those categories up, if you add up the medical and dental, the sales tax, the interest, including this, you don't forget now you can deduct the interest on your car that up to 10,000 on your car. You can also deduct your contribution. If you add that up, then that total more than your standard deduction allowed, then you go with your itemized. So in other words, you get a chance to deduct the interest on your house, on your car, the contribution, your taxes, and your medical. So that exceeds your standard deduction amount, then you go with your itemized. That's what we do. We're going to go the best way. They're going to give you the best tax advantage.
Thank you for clarifying this, because there's a lot of clients that say, I would like to use my itemized deduction. I said, no, it's better the standard deduction because the amount you're claiming, right?
That's correct. And plus, see, another thing too about the standard deduction, by the itemized deduction is really the standard deduction is that they're not going, you don't have to worry about nobody auditing you because they give you that by law. So they're not going to call and ask you to verify something.
Right.
As opposed to the, itemized deduction, they may want to look at your contribution or look at something. But with standard deduction, that doesn't look at because you're entitled to that based on your filing status.
Perfect. That's good. And Scott, let's talk about the brackets for 2025.
Okay. Yeah. Once again, your brackets are simply everybody pay the minimum amount. That's the minimum. Everybody gonna pay 10%. The 10% of what you're gonna pay. That's the minimum. So whether you make $1 or $1 million, you got a minimum tax bracket or 10%. So and they begin, I think, in this year in 25, they were like on the old law, they were like 10% bracket, 12% bracket, and then you had the 20% bracket. You had to go up to about 30%. But now on the new law, they start at 10, it's 15, I think it's 20, it's 20, it's 28, 27, something like that. Then it jumps up to 39.6. So you got a different change. What it is, the bracket tax you at your different income taxable amount. Like let's say your taxable income is 100,000. Okay, so you might be taxed on the $100,000. You might be taxed at the 15 or 20% bracket. Then let's say if your income is maybe 15,000, then you might be taxed at the 10% bracket. So the changes, the percentage that you're taxed at, changes with the level of your taxable income. So that's when those brackets kick in. So we're paying this year, beginning 25. We're going back to the old law before they changed in 2017. So your maximum tax bracket you're going to be paying on this year for 25 is 39.6 based on your taxable amount.
Perfect. And another credit that the people ask me a lot about is the child tax credit.
Child tax credit.
Uh-huh.
Okay.
I think that this year is gonna be higher than the last year, correct?
Yes, that's correct. For this year, the credit going to go up to. They increased it to $200. They're going to increase by 200. So instead of 2,000, it'll be 2,200. Now, in that bill, when I was looking at it, they had suggested that they're going to take it back to the old rule before 17 changed. But they decided to go ahead and keep it at 2,000 and then increase it by inflation, by the consumer price index. That's where the other $200 comes from. Because inflation, they just raised it up to from 2,000 to 2,200. So for this year, for your child tax credit, instead of getting 5,000, instead of getting 2,000, you get 2,200. And keep in mind now, they didn't change the age limit. So the age limit on the current law is that if you're 16 or under, you get the 2,000, or in 25, you get 2,200. If you're over 16, you only get the $500 credit. So the age limit didn't change. So the maximum you can get for age 16 and under will be $2,200. So they give you an extra $200 for 25.
One thing that I think is very important to clarify to the people is that there is a limit the children you can claim, right? Because they think that you're gonna get 2,200 per child, but they say, okay, I have 5, 6, 7 children. They cannot claim the 7. They're gonna give just, for example, the 3 children.
Yeah.
The maximum, right?
Yeah.
If you have 4, 5, 6, 7, it's not gonna be 2,200 for every one of them, correct?
That's correct for your earned income credit. Right. That's a good point. I do know people have 9 and 10 children, and when they claim, when you claim 3, you're only going to get a certain amount for the earned income credit. The maximum you're going to get is going to be $8,000, $8,026. That's the maximum. So you put more than 3 on there, it's not going to help nothing. It's not going to. The maximum you can get is $8,000. I think $26. So that is correct. You can that's all they're going 3. That's all you're going to need to get the maximum credit for earned income credit.
Yeah, that's very, very, very good to clarify, because some people think that I have 5, 6 kids.
Yeah.
I need to get this amount for every one of them.
That's a good point.
That is incorrect.
You're right. That's a good point. But it's kind of funny. Something happened to me about 2 or 3 years ago. The lady, she had about 10 children, 9 or 10 children, and she gave some of the children to somebody else to claim. And that was the year they came out with that stimulus. I think they gave them like $1,400 or something per child. And then after they came out with the $1,400, it wasn't planned, it just something they just did. And she came to me and want to know, well, what can I do? Because the lady won't give me gonna give me no money for my children. I said, nothing you can do, really, because if you could right now already, both y'all might go to jail, because you can't sell your children to nobody like that. So because in other words, they were actually setting children. If you had more than 3 kids, then they give somebody permission to do that, but you can't do that. That's illegal. Not unless they taking care of the child. If they taking care of the child, providing support, or they provide at least 20% or more of support toward the child support, they can claim them. But other than that, you can't sell your children.
Yeah, that's correct.
Yeah.
I have just another question regarding the child tax credit
Okay.
as a dependent. Okay, so you have to have some criteria to put a child as dependent, right?
Yeah, that's
So
correct. You
it
got
is,
5 rules.
Yeah, 5 rules. Can
That's
you tell
correct.
me about it?
Well, you got, let's see, you got relationship. Okay, you got what I said, age. You got relationship, age. You got the income. Then you got relationship, age, income, and then you got the you got marital status. You got the kind of cannot be married. Age. Then you got the what income, the age.
What about the residences?
Yeah,
They have to
yeah,
live with you.
That's well, that's a good point. The they don't necessarily have to live with you if it's your child or if it's a parent. Okay, the
Mhm.
parent don't necessarily have to live with you to be your dependent. If you provide support from them and they stay in another location, not in your house, if you meet all the other qualifications, you can claim them. Now, your child, if they're off in college, let's say they're off in college, then that also considers in your residence
Right.
because you provide for them. Now, if it's someone else, like a cousin or somebody, then you got to meet you got to meet the resident requirement. But you can have what they call what they call it. It's a relationship. A qualifying family member, a relative. That's what it is, a qualifying
Yeah.
relative. If they meet certain criteria, you can claim a qualifying relative also. That may not have to be in your house for the whole time, but you may not get earned income credit for them if they're not in your house. But you may be able to claim as dependent on the qualifying relative. Yeah. So those are the basic requirements. But normally, in other circumstances, they got to be in your house. They got to live there in your house.
Yeah, that is very interesting. Yes, because right here in the business, we have a lot of people who says, "Hey, can I claim this child as
Yeah.
a dependent?" But he's not living with me right now, and I said, "No, he has to live with you. Otherwise, they can't." For example, I have known many cases where the IRS sent a letter to the client and said, "Prove me
That they live
the
there.
kid is living with you."
That's correct. Now, when they send you that letter, that form is a 20. It's can't think of the form number now, but they'll send it to you, and then they ask you prove it. And guess what? Most times they ask you to get them a copy of the where they go to school at. Okay, they ask for you to verify with this. Because sometimes they ask for you to verify with the school, and then they would ask you for send a bill, to see where the child is living. So that is correct. If it's gonna be hard to claim somebody not living with you, other than a qualifying relative or a child off in college or your parents, because those are exceptions where they don't have to live with you. So I think on that form, they're gonna ask you, did this child on the tax return they ask, did this child live with you?
I have another question.
Uh-huh.
In case that they send you this letter, just for this matter or any other matter, and you can prove what the IRS is asking you to prove, can they change your amount, your refund amount, or you can go to penalty or something like that if you can prove
If
what
you
they
can
are
prove it.
asking? They are asking you for.
You mean if you can prove that they live with you and you're
Mhm.
taking care of them, then yeah, that they can. If normally they won't change anything, they just allow you what you claim. If you claim 3 children and they confirm 3 children, then you're gonna get what's on the tax return. Only time they would change it is when when you don't qualify for one of them. Or I got one client, the mother left and moved to Florida, and the children stayed with the father, and then the mother claimed the children. They're in Florida,
Mhm.
but yet the children didn't live with the mother. So another thing too, when you e-file a return, whatever Social Security number hit first, that's when they're gonna allow. That's when they're gonna accept. Whether you qualify to claim a child or not, if you file first, then once I already set that child's Social Security number, you can't e-file again because they already got it in the system. So what they're gonna do, this would happen usually, that we got to mail the other parent return in with the children, and then IRS gonna send a form back, and each parent got to prove that you provided for the child and that the child lived with you. So that's in most cases, the parent that the child does not live with, the child that IRS going to just allow the dependent. And the child that they parent live with and took care of, they're going to allow on that tax return. So that happens a lot. When
What happens when some clients they want to put in as a dependent a social security of a kid that he doesn't live with them,
Yeah.
and also he's not any relative. He's just like a friend to get some money. If the IRS finds this thing, can the IRS charge you as a fraud?
Yeah, they can do that. But no, they can do that. But normally, just like one time happened like that, they probably wouldn't do fraud on you. They just allow it, put a penalty on you, put the interest on you. And what you're saying is that nobody else claimed the child, but the person didn't take care of the child either, and they didn't live with that person, but they claimed them and put the social security number.
Right.
See, a lot of that get by. A lot of that get by already because there's no way they can track all of that unless for some reason they have a question about the child. But normally, if a person put down there like child and child 16 under, and they put down they got a valid social security number, and they put down the child live with them, even though the child didn't live with them. See, it'll be hard for them to catch something like that because they had no reason to suspect anything differently, unless there's a pattern. Or you got sometimes if there's
What about the last names? Can they see the different last names?
Oh yeah, but that's acceptable. The last name because you got grandchildren, then you got people that may have remarried or something like so. That's normal. They wouldn't necessarily change it. They wouldn't necessarily audit you if the child didn't live with you and you put the child live with you. So see that they wouldn't know that even with the last name, that wouldn't draw no attention to nobody. That wouldn't draw no attention, particularly if it's a grandmother claiming her grandchildren. They got different names. That's pretty much normal. And even though if the child didn't live with the grandmother, and the grandmother put child live with me on the tax return, that'll be hard for them, to know that they didn't live with them. See, because you got a lot of people probably doing that when they file. They're not being honest, what they call it. Because IRS depend on the preparer to be honest. And so, but they don't have no way of knowing that you're not honest unless something else come up and they two people claim the same child, then they'll start sending letters out. But if you just putting on there, the child don't live with you, but you put live with me, normally they won't have no way of knowing that.
I have the last question for you, Scott.
Okay.
Who at the end, who is going to be the responsible in front of the IRS? The client or the tax preparer?
Okay.
When you sign something.
Yeah, when you sign your document on that thing, and you sign that 8879, giving the preparer permission to file, the ultimate responsibility is going to be on the taxpayer. The ultimate responsibility is going to be on the taxpayer. And IRS would tell you that way you're responsible because some people say, I don't know what she put on there. I don't know what he put on there, And some people don't because sometimes people try and get people refund, They might put a big Schedule C on there to create a loss, and then they get a big refund. And they went to that person for that refund. But when they get caught sometime, they're like, well, I don't know what he put on. But the individual taxpayer is going to be responsible for the information on the tax return. Now, the tax preparer, if he have a pattern, of filing fraudulent returns, and I remember back in the 70s, that been 50 years ago, there was a local preparer in Birmingham that he was preparing false return.
Wow.
And we put all those returns. We put all those returns for that person. And we call a lot of those taxpayers, we call them in. And a lot of information was inaccurate. Depending on information, some people weren't even human. They were dogs. They were claiming putting everything on tax return. On something like that, then the preparer would be responsible. IRS would come in, take a license away from him. Sometimes they'll send him to jail if he did not report the income that he received from the people. But the ultimate responsibility is going to be on you. So make sure you know what's on your tax return. That's why you need to come to somebody that has a good reputation of filing tax return. So that's why you need to come to us so we can make sure that what goes on that tax return is accurate and correct. And you get every dime that you're entitled to legally so you'll be able to sleep at night. Don't worry about nobody putting something down and making something up because we don't do that. We file information based on what the client brings us. but the client is ultimately responsible. Unless there's a pattern where the preparer is intentionally filing false return, then they'll go after both the client and the preparer.
Yeah, that's right. Thank you so much,
You're quite welcome.
my friend. So, do you have any message to tell to the public?
Well, the only thing I can tell you is to get ready for this tax season because they're going to be different. There's a lot of changes we didn't discuss here this time. We may discuss some of them later, but just try to make sure you have all your information and try to keep the records for at least 3 years. Whatever you claim on the tax return, try to keep the records for at least 3 years and make sure that person that does your return is a reputable person and he's an honest person and that there's someone that you have trust in doing that return because you're going to be ultimately responsible for it. And also, you might want to do a pre-filing. What I mean by that, maybe like the last quarter, last 3 months of the year, particularly if you got high income, you may want to get with your preparer and give them your information from year to date to give you an estimate. You see if you're going to owe any tax. If you say, well, you're going to let's say you come in November and you got year to date, all your income, and you estimate the last month or two to see where you're going to stand. If you see where you're going to owe tax, then you want to pay at least 90% of it before, I think that January 15th. Then that way you won't be penalized. And because instead of filing an estimated tax, if you can afford it, you just pay it at least 90% of what you're going to owe by January 15th. And that'll keep you from being penalized and having to pay a penalty and interest when you file for 25.
Perfect. Sounds good. Actually, we have too many topics that we're going to discuss the next time.
Okay.
But today is more than enough. And thank you so much, my friend.
Yes, sir. Enjoyed being here. Once again,
sure.
We're
going to do it again and again.
Okay.
So we're going to be ready for the next season.
Okay. I look forward to it.
Thank you, Scott.
All right.
Okay. Thank you, friends. It was Raul Trujillo for Alabama TV.